Hello traders, Gary Wagner here, approximately 12 a.m. in Honolulu, Hawaii. It is Friday, the 7th day of October, and this is the daily report for gold, our weekend review. Gold did close lower today, but it closed well off of its lows, closing at 1637.40. That is basis the cash market. In the most active December contract, the market closed at 1635.80. That is the most active December contract. Now, when we take a look at these charts, these are weekly candlestick charts, you can see that although it is a rather small-bodied candle right in here, this represents the week, this trading week, it is the first week in which we have seen an actual higher close as compared to the open. In other words, they take the open on Monday, the close on Friday, and this is what creates that candlestick. When we consider the kind of sell-off that we have just witnessed, in which we saw this market go from above 1900 to below 1600, 1537 I believe as an intraday low, and now is trading roughly $100 off that low. It is absolutely clear to me that we have been forming a base and creating a good level of support here in which I think this market can build to higher prices. Traders, we are looking at a daily chart of both the cash month of gold as well as the dollar index. And as you can see, when we take a look at this market beginning in July, this was that incredible rally in which we saw the market move from about $1478 up to about $1,900. It did so in July, August, all the way up until September, as you can see right in here. Now, when we take a look at the dollar index, now the dollar index really was pretty much all over the board, but in September, it hit this bottom right in here, right at around 73.70, and never looked back. The market went and climbed up to a high of 80.50, and as you can see, during that same time, we had that inverse reaction with gold, in which gold traded to 1537 on an intraday basis and is now roughly $100 off the low. Take a look at our daily chart in terms of the rally as well as in terms of this ABC correction that we are now witnessing. When we take a look at the Fibonacci retracement, and this is created from February's low right at around 1310, so a $600 move, and what you can see is that at least on an intraday basis, the market actually sold off to the 76.4% retracement level, which is 1536, before kind of settling and finding this band of support, which is at 61%, and of course the 61% is 1640. The other thing that I'm noticing is we are getting a very interesting kind of a V at the bottom of this market right now, and that is also a very strong indication that this market has found adequate support and is building a base currently. We are looking at a 1440. That is a daily chart that's broken down into minutes. It is of cash gold. I have put a Fibonacci retracement, and the retracement itself is from the beginning of the large rally in February, so we can line up and get some real strong indication of where our different bands of support and resistance are. You can see this is the 1539, that is our low. You can also see the 50% retracement has turned out to be rather important, because when we look at it, you can see that the real bodies of all of these candles in here are above that particular support level. At the same time, you can see that the highs are just at the next target level, which is 1681. We have failed to be able to take out 1681 as resistance. So we have been trading within this narrow band, but we are trading off the lows and towards the mid area. Now, we did take a position. We got in at 1640 We also look to protect that position by getting a put option, very little time. It's in November, 6/25. And so in that way, we should be able to weather any kind of the intraday volatility that we have seen in the marketplace. Where are my targets? Well, my first target, of course, is going to be 1681. It hasn't been able to take that out. But once it is able to take that out, I am looking for the market to move back over 1700. And the actual target that I'm looking at is 1764. 1764 is the 23% retracement level, and I believe that the market has a good opportunity to get to this point. Traders, even with our upper level target, as I said, the mid 1700s, we are looking at a 480-minute candlestick chart. It is in Henkin format. I do want to point out one thing, and that is that the wave count that we have been working with really is our intermediate wave count. And as you can see, from 3 to 4, this is a major count. You get your A, your B, and your C. Then from 4 to 5, of course, you would get your 5 count. 1, 2, 3, 4, and 5. The reason I bring that up is my belief is that we have seen an A, B, and C, but that ABC is really of the minor count or intermediate count. And in terms of a major count, the major count puts this low at a major A. And so for that reason, my belief is that we'll probably see this as a B wave on the larger picture, the major count, and that, as I said, should take us anywhere between about 50 to 75% of this move, and then we will see one final C wave down on the major count, the C wave down, and that is going to take us through and close till the end of the year. My belief is that once that is concluded, we will re-enter an impulse phase. That impulse phase will begin to take us to new record highs. Now, in order to do some forecasting, I'm simply using Fibonacci extensions. And I have simplified the process, but I think you'll find it comes out with some fairly amazing results. First, when we go to the beginning of this major bull rally, this is back in October of 2008, and we look at this move from $700 to $1235. That is our full cycle, our 1 through 5, and then we get our ABC correction and we begin that phase again. A 38% extension of that comes to 1439, and if you look at that, that happens to be pretty much the exact top of this particular highs that we got at the end of 2011. If we look at a 123% extension, it comes to 1890. Let's take a look at the second Fibonacci extension. This is going from February 2010 to November 2011, 1050 to 1440. And if we take a look at the 123% extension, that takes us to the actual absolute top of 1919. The other interesting thing is that when we look at the correction that we saw within the market, in other words, when this market came, hit that high, and then corrected, the 23% correction level was 1534, and you can see that matches up rather nice. That being said, this is the frontward forecasting that we can do. This is based on the same rationale and logic that we used on these last examples. So we're using 1310 to 1920. And then we're simply looking at a series of extensions. So that if the market simply extends as it did here to a 38% level, that will take a new price in gold up to 2156. However, if it's able to take a 123% extension, as we saw here, and as it took 2 cycles to complete here, now you're looking at 2676. What do I think is more realistic? I think that it is in the high realm of probabilities by the end of 2012 that we will see gold at least at 2156. This has been Gary Wagner, wishing you as always good trading. and we'll talk to you next week for another daily review. Bye-bye.
Picasso had a saying, he said, good artists copy, great artists steal.
People say you have to have a lot of passion for what you're doing, and it's totally true. And the reason is because it's so hard that if you don't, any rational person would give up. It's really hard, and you have to do it over a sustained period of time. So if you don't love it, if you're not having fun doing it, and you don't really love it, you're going to give up. It was a photograph of an early morning country road, the kind you might find yourself hitchhiking on if you were so adventurous. Beneath it were the words, "Stay hungry, stay foolish." It was their farewell message as they signed off. Stay hungry, stay foolish. And I have always wished that for myself. And now, as you graduate to begin anew, I wish that for you. Stay hungry, stay foolish. Thank you all very much.